friends, welcome to the Kolkata Buzz. Today we'll give you special information related to India overtakes Hong Kong to the become fourth largest stock market. India's stock market has overtaken Hong Kong's for the first time in another feat for the South Asian nation whose growth prospects and policy reform have made it an investor darling. The combined value of the shares listed on Indian exchange reached $4.3 trillion as on Monday's close versus $4.29 trillion for Hong Kong's, according to the data compiled by Bloomberg. That makes India fourth biggest equity market globally. Its stock market capitalization crossed 4 trillion for the first time on December 5, with about half of that coming in the past 4 years. Now question is that why India's stock market is booming? Main reason stable political environment and consumption driven economy. Indian equity are surging fueled by growing base of retail investor and robust corporate earning. India presents itself as a variable alternative to China, attracting global capital and companies due to its stable political environment and a consumption driven economy, among the fastest growing globally. India has recent years expressed a clear intention to expand its role in global manufacturing and trade, aiming to emerge as a visible alternative to China. This strategic shift has been emphasized by Finance Minister Nirmala Sitharaman, who's highlighted India's plan to incentive production and bolster its domestic consumer market. For decades, China dominated global manufacturing, earning the title of Factory of the World. However, recently global events have sparked a reconsideration. Additionally, the ongoing trade tension between China and United States have created an opportunity for India to position itself as an alternative manufacturing hub. China's appeal as a global growth engine has diminished. This upward trajectory in Indian stock contrasts sharply with Hong Kong, which has experienced a historic downturn. Factors, factors contributing to Hong Kong's decline, including strength anti-COVID-19 measure in Beijing, regulatory crackdown, a property sector crisis, and geopolitical tension with the West. This has diminished China's appeal as global growth engine, resulting in a significant equity downturn, with Chinese and Hong Kong stock losing over $6 trillion in total market value since their 2021 peak. China is set to unleash fresh fiscal stimulus to shore up its economic recovery, drawing on a well used playbook that relies heavily on debt and state spending but falls short on the deeper reforms called for by a growing number of analyses. Some government advisors are recommending China lifts its 2024's budget deficit target beyond the 30% of gross domestic product set for this year, which would allow Beijing to issue more bonds to revive the economy. Pre-COVID market capitalization on each major exchange in India was about $2.16 trillion. The 2019 stock market really was limited to 8 to 10 stock within the large cap. The Sensex returned around 14% excluding dividend for the year 2019, but prominently featured blue chip companies such as HDFC Bank, HDFC, TCS, Infosys, Reliance, Hindustan Unilever, ICICI Bank, Kotak Bank, without which Sensex return would have been negative. However, in the start of 2020, there was overall recovery which led both NSE and BSE trade as their highest level ever, hitting peak of 12,362 and 42,273 respectively. At the beginning of the year, there were close to 30 companies that were expected to file IPOs. The market condition was generally favorable as their witnessed record high at mid-January. An unfortunate pandemic, the COVID-19 has resulted in an economic, financial and medical crisis in the country. There are tough times, but mankind is know how to be together and will bounce back from this stronger than ever. To revive the economy and boost the business, a smart recovery plan is essential. The country need to focus on attracting foreign investment and must reduce importing products. We must encourage product made in India and support local products. RBI and government of the India has come up with a number of reforms such as reduction of repo rate, regulatory relaxation, both boost liquidity in the system in response to the current situation and keeping in mind the chaos of pandemic has created. Thank you. We will be bring all update related news later. Thank you for watching the Kolkata Voice.